Welcome to This Explainer. I am so glad you're here. Look, we're going to tackle something today that usually makes people just want to hide under their covers: taxes. Tax season, right? It's literally a universal chore. But what if saving on your taxes could actually be the engine that drives your long-term wealth? Today, we are completely demystifying ELSS funds. We're going to flip the script on tax season and turn it from an annual headache into a genuine opportunity to grow your money. So, what if your tax savings could actually make you rich? Honestly, it sounds a little too good to be true, doesn't it? We usually just think of tax savings as, keeping a tiny bit more of our paycheck. But what if the exact tool you use to get that tax break was built to multiply your money over time? We're talking about the ultimate two birds, one stone strategy for your personal finances. All right, let's get right into section 1. What are ELSS funds? Time to unmask this acronym. Okay, let's dive into this. The financial world absolutely loves its confusing jargon. An ELSS is the perfect example. It stands for Equity-Linked Savings Scheme. I know it sounds like a ridiculously boring government form, but let's strip that away. Equity-linked simply means invested in the stock market. That's it. An ELSS is really just a mutual fund, a pool of money managed by pros that buys shares in companies. And because it's doing that, it has the potential to give you those solid long-term returns the stock market is famous for. So think of it as an investment first and a tax saver second. So where does the tax saving actually come in? Well, under Section 80C of the Income Tax Act, the government essentially gives you a discount coupon. You can claim a deduction on your taxable income up to a maximum limit of 1.5 lakh rupees. If you invest that amount into an ELSS fund in a single financial year, the government literally pretends you never even earned that money when calculating your taxes. You are completely shielding it from the taxman. And here's the real wow factor. Let's say you're in the highest 30% tax bracket, right? And you maximize that 1.5 lakh investment. By doing that, you could save up to 46,800 rupees in actual hard cash that would have otherwise gone straight to the government. That's money staying right in your pocket every single year. It's basically an immediate guaranteed return on your money before the stock market even does a single thing. Moving right along to Section 2, how ELSS builds wealth. Let's talk about growing your money. We've covered the tax saving side of things, but how does your money actually go to work once it's inside? Well, an ELSS fund has a very strict recipe. By law, a minimum of 80% of the fund's corpus, and hey, corpus is just a fancy financial word for the total pool of money, must be invested in equities, which is just another word for stocks. The fund managers spread this out across different sectors to balance the risk, but make no mistake, that massive 80% equity chunk, that is the engine of your wealth. It's exactly why ELSS funds have historically beaten inflation and grown money so well over the long haul. Now, in the spirit of total transparency, we gotta look at the fine print. When your money grows and you eventually decide to pull it out, you do have to pay a small tax on the profits. It's called long-term capital gains, or LTCG. But don't let that term scare you. It literally just means the profit you make over time. And the rules are incredibly favorable. Your first 1.25 lakh rupees of pure profit in a given year is completely tax-free. So say you make 2 lakhs in profit. That first 1.25 lakh is tax-free, and you only pay a 12.5% tax on the remaining 75,000. It is just a highly, highly efficient way to grow wealth. Which brings us to Section 3, the 3-year lock-in rule. Honestly, this is a total blessing in disguise. Now, what's really interesting here is that people often get super nervous about this lock-in period. Let's completely reframe how we think about this. Yes, every single ELSS investment is locked for a mandatory 3 years. You cannot touch it. But here's why that's actually brilliant. The stock market goes up, it goes down, and beginners, well, we tend to panic and sell when things look slightly red. This 3-year lock-in forces you to be disciplined. It protects you from your own panic. But pay close attention to how this works, especially if you invest monthly through a SIP. The 3-year clock applies to each individual installment. So if you put money in during January 2025, that specific chunk unlocks in January 2028. Your February chunk, that unlocks in February 2028. Every single piece of money gets its own personal 3-year countdown clock. Let's move over to Section 4, ELSS versus traditional options, the ultimate showdown. Beginners often feel totally paralyzed. It's like you're forced to choose between completely safe but mind-numbingly boring tax savers or confusing, risky stock investments. And this brilliantly illustrates how ELSS stacks up against the competition. Look at the traditional options under Section 80C. Public Provident Fund, or PPF, you are locking your money away for a staggering 15 years. National Savings Certificate, or a tax-saving fixed deposit, that's a 5-year wait. ELSS has the absolute shortest lock-in period of them all at just 3 years. Plus, while the other options give you safe but fixed returns that barely beat inflation, ELSS is market-linked. Sure, it carries moderate risk, but it's the only tax-saving option that is actively trying to create serious wealth for you over time. Okay, Section 5, How to Start Investing. This is your action plan. Learning all this is great, but taking action is where the actual magic happens. Let's get you off the sidelines. You basically have 2 ways to put your money into an ELSS. A lump sum is exactly what it sounds like, taking a big chunk of cash and investing it all at once. But for beginners, the SIP, or Systematic Investment Plan, is going to be your best friend. Think of it like a gym membership for your finances. Instead of paying for a whole year up front, you auto-invest a small, totally manageable amount every single month. It builds that habit of wealth creation without needing a massive upfront cost. And it smoothly rides out the natural highs and lows of the stock market. And getting started is literally a 4-step process that you can do entirely from your couch. First, complete your KYC. That stands for Know Your Customer, just a simple online identity check required by law. Second, choose a registered online investment platform or app. Third, pick your ELSS fund. You can easily compare them right on these platforms based on their track record. And fourth, start investing. No pushy agents, absolutely no mountains of paperwork. The whole shebang is 100% digital. Now, if you're sitting there thinking, yeah, I'll start when I have more money, I'm going to stop you right there. Just look at this number, 500 rupees. That is the minimum amount you need to start a monthly SIP in most ELSS funds. Literally, for the cost of a couple of coffees or a fast food meal, you can officially call yourself an investor in the stock market while simultaneously claiming a tax deduction. You absolutely do not need to be rich to start investing. You just need to start to become rich. Which brings us to our final thought. The financial year is always moving forward, and the clock is literally ticking on your tax savings. You now know that ELSS is simply a stock market mutual fund that saves you taxes today and builds wealth for tomorrow, all with the shortest lock-in period out there and an entry price of just 500 rupees. So I'm going to leave you with this. Are you going to just keep paying your taxes and complaining about it, or are you finally ready to make your money work for you? Thanks for joining me on this explainer, and I highly, highly encourage you to take that first step today.